All right, Ryan, we're back for another Casual Friday.
Yep, and I'm casual again, and you're not. You're a little bit better
I know.
today.
I'll tell you. So let me tell you why I'm not casual on Casual Friday. I had a meeting with some clients, with them and with their accountant, who we work with a lot. I won't say who it is, but they're selling some property up north. They're selling a ranch up north, trying to figure out what we're doing with it. 1031 exchange. How do we save on taxes? How do we stay liquid? Trying to work all of these things out. And so I was dressing professionally today for that. But that meeting reminded me about the importance of having a financial advisor and an accountant, and not yet in this case, but eventually a good estate planning attorney, because they're actually working with somebody we work with quite frequently to create this team, this financial team that works well for you. And so today it was actually a really good meeting at the accountant's office because we were able to kind of work together and brainstorm and come up with the most tax efficient way to achieve the goal that this person wants to achieve with the sale of this property and making sure their future is secure. So, pretty cool. Right?
Yeah.
There's so many people sit and wonder, oh, well, I'm going to do this, but what are the tax implications? I have some choices, but I'm sure I have some choices. I don't know what they are. And we were able to kind of in an hour sort all of that stuff out. And they left the meeting feeling good.
Well, each person usually has a different perspective. Each professional has a different perspective and could add maybe a little piece that the other side doesn't. I mean,
sure.
Sometimes so I know for us, sometimes like a lot of times in those meetings especially with people that have businesses or selling those kind of assets, like sometimes like the retirement plan may come in there, but the accountants know enough about some of the retirement plans, but not the details. And so each person could lean on each other to like come up with a full plan that could work for the client.
Well, in this case, if you were working in the abstract and just say, we're going to sell this property, what's the capital gains? And therefore, what's the capital gains tax? This property had been inherited a couple generations, so the basis was super, super low, even with step-ups. And so there was almost a six-figure kind of tax burden from the sale of it. And so then you wrestle with, like, we'll do an exchange. Well, if we don't do an exchange, but we invest it and it stays invested for 5 years, what are some reasonable returns that you could gain maybe in the next few years to help offset some of the tax burdens? And so it was this really open, kind of fluid discussion that I think was eye-opening for the clients. And it was good because we knew we were coming at it from all angles. And so working only with an accountant or working only with a financial advisor or even only with an estate planning attorney gives you a lot of the story, but maybe not the whole story. And so having everybody in a room was great. There are some of those days where you do good financial planning and it's satisfying, and certainly today was one of those days, at least for me. So let's talk markets a little bit. We said this on the podcast on Monday. Last week was terrible, right? The Fed came out and was talking rates and talking tightening and all sorts of stuff. Market flipped out on Wednesday, Thursday. It was a negative week last week. This week,
we will say it was a terrible week in looking back at the recent past, right?
Yeah.
Let's talk context, there's some context of like, we've been on a very good streak. We haven't had very much volatility. Therefore, when you have a small down dip in the market, it feels worse than maybe it really actually is. And especially in comparison, to some of the larger drops we've experienced over the last several years.
We dropped, into February to the end of March last year, we were down 30%. So last week was not that.
No.
But it was as difficult of a week as we've had. And I know we're Friday talking about the prior week right now. But it was noteworthy because the Federal Reserve came out, provided a new dot plot, giving some guidance on interest rates and what's going on with the markets and how the Federal Reserve views what's going on in the economy. And so that's instructive. And it's not uncommon for the market to have some sort of knee-jerk reaction to say, oh, well, the Fed's going to tighten or rates going to go up. And then everybody sobers up after a few days and actually figures out what's going on here. And that sobering up seems to have been what happened this week, right?
Well, also too, I think, we always talk about how when the market goes up for a while, kind of consistently, it almost looks for a reason to go down.
Sure.
And so even though what was happening with the Fed news maybe wasn't, it wasn't really that negative. Again, maybe it was enough of a discussion point for the market to have a reason to go down.
Well, it's almost like the market at some point peters out and you run out of reasons to go up. And so then investors look for reasons why it should go down.
Yeah, absolutely.
And so it was a bad week last week. This week, the Russell 2000 was up 5%, 4.99 to be exact. Well, let's call it 5%. The small caps were on a tear. The NASDAQ was up. We'll talk a little bit more about the NASDAQ, but the NASDAQ was up about just short of 2.5%, which was the worst performing of the three largest indices. S&P was up 2 3/4. Dow Jones was up nearly 3.5% just this week. We fully recouped what was lost last week and then
some. Yep.
And looking at this, value has seemed to outperform kind of
everything
pretty consistently this year.
Right. It was, and maybe it goes into what is the value, what's inside of those value stocks, because when we talk about growth and we talk about value, I think people need to know what kind of sectors are in there. Growth tends to be your technology stocks, could be your medical technology type investments as well. And then you have value stocks, which a lot of times consist of your energy stocks, your financials, real estate investments. And so when you start to hear like the sectors, you understand that financials and energy were hit really, really hard in 2020. Therefore, they also have a lot of room to play catch up. And I would say really, technology was such a great investment in 2020,
and even beyond, right before that.
And to be honest, it's done well,
but it went nuts last year.
Yeah, it went nuts last year in comparison to everything else. And then really, since I'd say COVID, the vaccine news has started to come out late last year to present, value has done tremendously well.
Well, and if you think
over the time frame,
if you think stock prices are some expression of how investors think things are going to go. We got into COVID and everybody's watching Netflix on their iPhones last year. It's not a surprise that companies that are tech companies that service like kind of at-home stuff that we all do did really well last year. But you have to also think they ran out way, way far ahead. And so now so much growth is baked into those stock prices that at some point they have to have some time for the actual earnings and revenues to catch up to whatever the prices are now. Whereas the value stocks, the stuff that is decidedly not sexy investing, right? It's like manufacturing,
your old school investments.
Yeah, telecom, old school investments, right? They're the ones, they didn't run out ahead. And so as the economy is red hot right now, they're benefiting from that. Everybody's benefiting from it, but their prices just haven't gone out so far ahead. So they're getting the benefits now that maybe some tech stuff got last year.
Well, I guess if you put it into like real life, you think about, let's call it Netflix or Peloton or like Zoom, right? These are all technologies we were very reliant on during COVID. But then as we fast forward and get out of it, gyms are opening up. So people may use the Peloton less, or you have Zoom. People are coming back into the office. So you're not having Zoom meetings as much. Yep. And so you are having to pull back in the use of these things. Therefore, you can understand why people maybe not be as high on those stocks as well.
Let's just use our office as an example. We now basically with clients and talking about their annual reviews, we can do it over the phone. We can do it over Zoom. We can do it in person. And until very recently, it was just phone and Zoom. I don't know what your July looks like, but my July is full of a lot of in-person meetings. And so, talking about Zoom, it will stick around for sure. And we're not commenting on the price of Zoom or are offering some sort of analysis on where we think it's going to go from here. But the fact is that some of the things that we took up during COVID will remain, and some things will probably dissipate or go by the wayside. It seems to me, just based on our household habits, grocery shopping online is the only way to go, right? That's something that's going to stick around. I can tell you personally, I will keep riding the heck out of my Peloton, COVID or no COVID, but that's just me. But Zoom, you're right. It's like a lot. No one's going to do any more Zoom happy hours. Let's put it that way. Right.
Right.
It comes off of the using Zoom for everything and then getting back to using Zoom for some things, perhaps.
Yeah. And then as you continue with that real life story, again, going to the value side, which is, we'll pick on energy, right? Energy, you would understand, would be beaten down in a COVID type of environment because we weren't driving and traveling, right? And that's at least a large portion of energy. But then, of course, as you open up, I think we could all say we know lots of friends and family that are traveling in the next couple of months, right? And
I think there are two guys on this webcast that are going to be traveling in the next month.
Yes. So we're so energy is being consumed at a very now in this non-COVID environment as we come out, and so prices are coming back up, right? And so again, this real story, we can all make sense of why this is happening, why the value play is coming back.
Well,
now.
And there's even some weird stuff, right? Like semiconductors. We don't have enough chips to make cars.
Yes.
We have some real supply bottlenecks here that
will get fixed.
Will get fixed in time. It's really odd. It's causing some inflation. And there's certainly two views of, you can't increase the money supply by 25% over the course of 12 months and not expect some inflation. But then there's a different group of people thinking that inflation is simply just manufacturing bottlenecks, and that's why we're having some inflation. I don't know. It's got to be somewhere in between there, of course. But
I would say it's somewhere in between.
Speaking of tech stocks, this wouldn't be Casual Friday if we're not looking at a few charts. And so I want first to take a look at the NASDAQ reaching new all-time highs. We were talking about how value stocks are really doing quite well. Not shown though. I'm gonna see if I can zoom in here. Not shown though is the fact that the NASDAQ is still doing well, even though value is doing better. NASDAQ tends to be kind of tech heavy. And so you can see it got leveled after 2000, didn't hit new highs for another, 15 years by this chart. But even this year, we've hit the NASDAQ, even though it's lagging behind some other indices for the year, is still hitting new highs. And so tech and NASDAQ type stuff isn't out of the conversation just yet, right?
Yeah. And the technology companies are spread throughout, right? Meaning that this is just a representation of the NASDAQ, but the big players inside of the NASDAQ, being say Apple and Amazon, for example, they're inside of the S&P 500.
Sure.
So even your more broad index that's not specifically just technology, they're inside of there. So even if you didn't own the NASDAQ, you probably own something closer to the S&P 500. You have the representation of technology inside the stocks. Inside of those indices, and technology continues to move upwards.
You're going to get some you're going to get some overlap in the broad indices, right?
Yeah.
There's when you have big behemoths in there, you're going to get a little bit of everything, whether it's Apple being represented in more than one, or unless you get into the Russell or the EFI or some international kind of indices, that's when things can start to change a little bit. We talked about supply bottlenecks, and I've got one here. I've got a chart here for you to take a look at. Let me get it going here. This is also from LPL Research. This is the manufacturing PMI, and it looks like by the most reading, we are hitting new manufacturing highs. And you can see the crater that came last spring, early summer. But the manufacturing, the race is on to fill all of these orders as consumers get out there and aggressively make up for lost time.
Yeah, there's a backlog of that needs to be filled with all the goods and services that people have been looking for and been kind of missing out on. And I think we're seeing that. I think both, honestly, on the service side and the actually good side as well. I think that you can't just call up people to come to your house if you want to do something, remodel a little, even a little something. You can't just call them up and expect that they're going to be there next week and start working for you, because there's a real bottleneck on the service side. And then as this shows, on things that are being manufactured, the actual goods, people are out buying things. And you mentioned the semiconductors, those have some constraints, and people still want their goods. It's just not as easy to get them right now.
Yeah, it's going to be interesting. Talking about calling people to help out our house, we cannot find an electrician to save our lives to put up some things in our house that need to be done. I think it's going to be interesting to see what this manufacturing PMI chart looks like a year from now or 2 years from now, because we're starting to get a little bit into this place where we've realized, or the U.S. is realizing, that we have sent so much manufacturing offshore. Whether you're calling it globalization or, it was just efficient to have things manufactured overseas and have this just-in-time economy that was totally disrupted last year. And you start to see some cracks, semiconductors. Okay, well, what happens if the largest semiconductor manufacturer in the world gets taken over by China or has some sort of failure? And then, what does that do with everything else? Drugs are another good example of it, where you have prescription medicine, whether it's the creation of them or the materials being created, whatever it is, it's not being done here. And so you're beholden, whether you like it or not, to wherever it's being manufactured, in many cases, China. And so there is this push, I know, from government and even through a public-private partnership to get manufacturing back here. I want to say it's like Intel that's creating a chip.
Yeah, I don't know. I mean, I guess it's the idea that if there's going to be a problem, you don't want to be, have it be the other person's fault. If there's going to be a problem, at least be in your own control.
Right. Well, it's been this interesting view for probably 20 years now, maybe 25 or 30 years even, probably since the early 90s, where it's all about efficiency, right? You try and widen margins as much as you can, control costs, whatever it is that needs to be done, and it's fine, right? It's too expensive to manufacture here. You manufacture somewhere else. You ship it, whatever, and it's done really well. And granted, manufacturing things here may be more costly, but it's almost like everybody's been operating without a bit of an insurance policy, right? With these manufacturing, having everything outsourced internationally. Bringing it home might be a little bit more expensive, but at least you have the insurance that you're not going to have a communist country taking over your factory or something like that.
Right. Yeah, you're right. It'll be interesting to see where this goes. I mean, with manufacturing, what we're trying to look at it as well is just to see what kind of demand there is on the consumer side, right? You assume that if those numbers are high, people are outspending their money, and therefore manufacturers have to produce goods.
Right. Well, and what's interesting, so we have another chart here that has manufacturing PMI over the last 20 years. And you can see there is a lot of ebb and flow. Even take out 2008 and take out even 2020. But you can see every, at least once a decade, you hit the skids pretty heavily, whether it's early 90s, mid 90s, tech wreck, Great Recession, just last year with COVID.
A lot of recessionary periods are these lows, which would make sense, right? You hit a recession, people lose jobs or tighten their belts and don't spend money. Manufacturers are going to hit the brakes, and then you see the line fall downwards. But what's funny as well is how fast they bounce back, how sharp it bounces back when things
I would say even how sharp it is on both sides, right? It's that we are flying high right now as we come out from the crater from last year. But you look at the different peaks, whether it's the 05 or 95, we don't ever stay there. Manufacturing PMI has lots of peaks and lots of troughs, but no plateaus. And so it's going to be interesting to see where we go from here. We might dip and go higher again. And without a crystal ball, none of us really know. But it's interesting to see that kind of, this is a really volatile chart to my eye, where, you hit new highs and then not too long after that, you hit new lows.
Yeah. And realistically, you probably want to spend your, bouncing around in the middle is okay. When things are really good, you probably, like anything, the only place to go is down. And
right.
You can say the same about when things are, at its lowest. Again, kind of an example.
Some charts though, Ryan, have at least like revert to the mean. You know what I mean?
Yeah.
They get somewhere close to average. It may drift a little higher, or may like a couple standard deviations higher, a couple lower. But this is whacked. This is all over the place.
And we're at real highs right now, which speak to the point of like how long can it stay there, right?
Yeah.
And you said fast forward 6 months. Again, like giving an example, I know like within my neighborhood, on both sides of me, my one neighbor is remodeling their kitchen. My other neighbor is doing some remodeling. Across the street, they're painting the house. 4 houses down, they added a new garage, like twice as big of a garage. Now, while all of this is happening, that people can't continue to spend this money, and they're not going to continue to do this year after year, right?
Right. You only put in one garage.
Right. And so, you're only going to remodel one kitchen. So therefore, like, a lot of people are doing things now, but realistically, we can't all continue to do this kind of stuff.
And we're all doing it at the same time. That's the real crazy part here. So, it almost gives the ammunition to the Federal Reserve's idea that this is the inflation that we're experiencing right now is transitory, because you're right. Like it's like a pig running through a snake. If we're all trying to do everything at the same time, if you want the painter to show up to your house, you're going to have to pay him more than the neighbor wants to pay him. And that's going to be some inflation. But when those jobs start to dry up, suddenly the cost gets a little bit more competitive. So, I think that speaks to how temporary these inflation numbers could be as we go forward.
Have you seen anything as you've gotten back out and, comparing prices? I know it's always hard to try to remember prices literally from almost a year and a half ago and kind of compare them to now, but have you noticed anything?
A little bit. A little bit. I know, when we look at prices, a lot of people look at food and energy, like food and gas prices, right? But those prices are volatile, especially gas prices. You have a refinery go offline, suddenly gas prices are whacked. Same thing with food. You can have some sort of issue or drought or disease for crops or cattle, whatever it is. Some other things. As far as inflation goes, I think for the last decade or so, as from my view, you have deflation in the stuff you don't need, and you have inflation in the stuff you need. So the kind of television you can buy right now, you can go to Costco or go to Target or Walmart, and you can get some 5K smart TV that streams all sorts of stuff for like $150. But college tuition, healthcare costs, those kinds of things that you have to have gone up. And I don't know how that's going to go post-COVID. So, prices going up, yeah, probably a little bit. I know the price of meat's gone higher, and the price of some other things have gotten higher. I know delivery times on stuff are way, way out. If you try and buy a piece of furniture, you can buy it right now on June 25th, and it'll get delivered to you on November 25th.
Yeah, that's that manufacturing bottleneck.
That's the manufacturing thing, right?
Yeah,
exactly right.
Yeah.
So, so you really get down to like, is this inflation stuff temporary, or is it here to stay? And really, the only reason we're asking this kind of question is because it's not so much that investors are worried about inflation, although some are, right? If you that cash and the savings account you're getting 0% on, it didn't matter 2 years ago when inflation was also zero or near zero. But now if you have inflation that's 4% and you're getting zero in the savings account, the basement level of investing should be keeping up with inflation, and you're not doing it at the bank. So how do things keep up? The answer is interest rates. And that's why there's this obsession right now with inflation. It's what goes on with interest rates. Is the Federal Reserve going to increase rates? I know the dot plot. Did you watch the dot plot at all last week?
I saw the chart.
You know, some board members were moving forward saying not 2024, but 2023, which still seems like ages from now. But, you know, it causes a bunch of concern. That's why not this week, but last week markets were down. But take a look at this chart. What goes on, or how do things perform after the first rate hike? And this is also from LPL and Bloomberg. You can see the S&P 500 returns from, this is in the last handful of years, going back to 87. When interest rates go up, how does the market perform? Everything but 1987 was positive.
Yeah. Overall, it's good. And if you kind of try to extract the reason why, you know, a lot of times the Federal Reserve will try to raise interest rates because the economy is overheating, right?
Right.
So you have a good economy, and just because they raise the first rate doesn't mean the economy just stops, you know, being hot all of a sudden,
absolutely.
Right? So it continues on. Now, you know, obviously, if you said, what does the interest rates do after the fifth or the seventh hike?
Yes.
Okay, at that point, maybe things don't start to look as good. But
that's the Fed pouring cold water on the economy.
Yeah. But after the first rate hike, you would expect the momentum of the economy, which is usually again hot, to continue to move that way for at least a while. And so therefore stocks continue to move in the same direction for a while.
Yeah. The first rate hike is the beginning of what is usually several rate hikes, right? Because they're not going from whatever the Fed fund rate is right now, let's say it's 0.5% to 3% tomorrow. It'll go 0.25%, 0.5% over the course of a couple of years. That will finally pour cold water on whatever bull market's going on. So I think it's interesting to have that. I think that's a really key analysis here, because it's easy to look at this and say, well, what happens after the first rate hike? Well, don't have some knee-jerk reaction. The Federal Reserve raises rates. On average, the return for the next 12 months out of the S&P 500 is more than 10%. Okay,
which we'll take. Yeah.
Which we'll take. So no reason to freak out at the first rate hike. But it should be a signal that probably more is to come, and you probably need to make some adjustments accordingly. I know, you know, for me, I've been using some low duration bond funds, starting to layer those into the portfolio, less interest rate sensitive. You know, you don't start putting the sandbags down in like after the rain or after the flood has come. You got to do it before it starts raining. And so there's this feel right now that, or at least for me, that might be time to start dropping a couple of those sandbags in a portfolio and prepare.
Right. It's just about preparing for what, you know, could happen. And we know that the Fed is now very notorious for trying to give us plenty of time ahead of time of knowing what they intend to do.
Truly.
So, you know, if this is something that, you know, they're not likely to surprise us in the immediate future. They may surprise us in the direction that they go 2 years out, but you know, in the short term, they're probably not likely to throw us a curveball. So we're preparing for what may happen in the next, you know, couple years.
It's almost as if they use their they work really hard to telegraph as part of the Federal Reserve policy, right?
Yes.
Like what they do with their announcements and their statements is almost part of some of the tools in their toolbox, if you will, where they can kind of pour cold. If they talk about raising rates, they can almost have the same effect as if they actually rose rates, right? But just threatening to do it, market reacts so swiftly, they can kind of keep a lid on things without actually having to make any policy changes. It's
the language that they use. It's very important.
Right. Well, it's going to be interesting to see where we go from here. You know, it really feels like we're in this kind of transition phase. The entire world is out. Markets are up.
Things are good. Things are good. Then people are good.
Yeah. You know, it's you know, I kind of feel sometimes like clients have us to be optimists when things are bad and pessimists when things are good. And I hate to walk around like some shoe's going to drop. But would it surprise you if in the next quarter we had a correction?
No, absolutely not. I mean, given the run up that we've had since, you know, April of last year, you know, you could again make that argument that we're due for one. Summers are volatile. As we had mentioned, both of us are going on trips, and it feels like the rest of the world is, planning vacations. Right. That's the time when people aren't paying attention to the market, and the volume's light, is ripe for, some kind of small correction during summer. It's very natural for volatility to happen in the summer to late summertime.
Yeah, I mean, historically, the weakest months of the year have been August and September. So, I've told everybody this and even said it on the podcast. Don't be shocked if you open your August statement in September and it's not as pretty as it's been for the last year.
And
we're
talking correction. This is
correction.
This is not doom and gloom.
We're not. Yeah. And most of our clients don't only own large cap stocks, which is kind of what we're talking about if we're talking about a correction. So could be worse in small caps, could be unaffected, like it could not affect bonds. It's hard to say. That's why you own a little bit of everything, and so that way you can kind of not get blindsided by whatever correction comes your way. So it's been a while since the local news has been here, right?
That's a good thing.
So that's a good barometer. When the local news shows up to document the huge drop in markets, that's usually a good sign. That's a sign of a bottom, right? When it's getting out there and it's mainstream. So we probably have a while before that goes on. Well, Ryan, I think we've kind of covered it all. We got 4 charts in, a good week under our belt this week. Hopefully we have another good week next week. For all of you watching right now, we're going to take a break from our Casual Friday broadcast next week, but we'll be back in July, covering not just the Casual Friday broadcast, looking at the weekend markets. Also, stay tuned for the mid-year outlook, which will be out in July, and we will have a webinar that you can register for us to take a look at what happened in the last 6 months and take a look also at what's coming here, what we think is coming at least in the next 6 months. So, Ryan, have a great weekend.
Yeah, you too.
All right, let's do it again soon.